today's video, I am going to be comparing dividend stocks versus growth stocks and which investing strategy is actually better. So let's get down to it. Let's check out each style stock and see which one could be better and some different ideas between or behind each trade. Okay, so first we're going to be looking at TD Bank. TD Bank does pay a dividend of 3.7% as of right now, and the average volume is not too bad at 4.9 million shares being traded every single day. Now, when it comes down to it, their PE ratio is one of the cheapest out of the Canadian Big Six banks, and something else that we can really look at is the beta. So, for example, the Canadian market, for every 1 point higher, generally that the market goes higher, TD Bank is going to be going up about 86% of that 1 point. So even though you're not outperforming the market, you are getting a bigger percentage of dividend when it comes to the market. So in reality, you're probably just slightly beating the market. However, one thing that I haven't mentioned yet is the fact that when you're talking about dividend stocks, something that Kevin O'Leary has mentioned quite a bit is the fact that with dividends, if you reinvest them either in the same stock or in other dividend stocks, you're actually going to be outperforming the market. And if you look over history, you can actually see this over the past 100 years. Dividend stocks, because they're paying a dividend, they are going to be more stable. Their charts aren't going to be going crazy like the growth stocks sometimes do. And because of that, what happens is if you are to invest in dividend stocks, you're investing in a solid company that's able to afford to pay a dividend at that point in time. You're going to be essentially investing in a company that should be here for the long term. So when it comes to the stock, you're essentially seeing that 5 years ago it was worth $60 and today it's worth $85. Of course, we had this downturn because of a virus. But if that virus wasn't around, this stock probably would have been still trading sideways until recently. However, would they have had this jump? That's a big question because, believe me, the banks made a killing when it came to people staying at home, not spending their money as much, and putting more money into the banks, which makes them more money. Either way, you're still looking at some small gains, some sideways trading action, and then a little bit more gains at the end of the 5 years. Now, when we look at companies like Tesla, Tesla is a growth stock. When we look at the volume, you're looking at almost 19 million shares being traded every single day, and it does not pay a dividend at all. Its PE ratio versus the dividend stock of TD is absolutely ridiculous. That's price to earnings. And at 400, you would automatically assume that this stock is going to be selling off soon. However, it's not, and there's actually very good reasons behind that, but I'm going to get to that a bit later. When it comes to that 5-year beta, for every 1 point the market goes up, this stock will go up about 1.89 points. So essentially, you're doubling, almost doubling, what the market is doing when it comes to the growth over the past 5 years. Now keep in mind there was a stock split, however, after the stock split you're looking at a stock that was basically around $40 a share 5 years ago and now worth $787 a share. Mainly because of this growth that we've seen over the past year between 2020 and the beginning of 2021. It has since pulled back, which we will always see. Anytime you look at a stock that is literally blowing up within a year, you're going to see a little bit of a pullback. That is going to happen. However, something that I really want to point out is by reading the charts, we can see that, of course, there was going to be some growth happening very soon. One way that you can really see that is if you can draw a flag, as we can see here, and then as soon as the stock price starts to go above that flag, well, guess what? It's going to continue to the upside. Will this continue? It's hard to say right now, but basically now it's trading within a range, and it's at the high end of that range. It may have some sideways trading action coming up, or if it breaks above that range, you may see, of course, some massive gains, or if it basically breaks below that range, then of course there could be some downwards action or still just some sideways action. So when it comes to growth stocks, it comes down to a lot of what the company's about to do, what the company's currently doing, are they making money, and also the charts. The charts tell a lot of what's happening with the company. Now, it's kind of weird how chart reading works. In my opinion, it's weird just mainly because it just seems to happen. Like for the last 100 years, you can look at charts and they have the same patterns over and over and over again. I don't know if this is to do with just some rich billionaire trying to make the markets go the certain way, or if it's just how companies work. I like the conspiracy theories behind it, but it just comes down to how companies work and how the charts work. But anyways, so what else that we want to look at with growth companies is this. So many people make mistakes when it comes to growth companies, and then they say that the market works against them. Financials are extremely important when it comes to the stock market and when it comes to growth stocks. There are so many people who will read stuff online and say, hey, that's a great stock. I need to get my $1,000 or my $10,000 into that today. And then it tanks. Well, guess what? There's growth companies that are speculation, and then there's growth companies that are legit growth companies. A speculation company would be something like GameStop, where they're not making any profitability right now. However, they don't exactly have a fantastic plan going into the future other than potentially selling more stock to maybe pay off some debts because people have bought into their stock like crazy. And then maybe eventually 5 years down the road, they may be something. They're going through a transition. It's a rough period. However, you can get into a growth stock, still a speculation, but something like a Tesla that has a product line that also is profitable. That is key when it comes to growth stocks. Something else that's key is what do they have coming down the pipeline in the future. So for example, Tesla has their solar panels, their solar roof, their batteries, their cars. But that's not just it. They also have software for a lot of these electrical companies around the world who are buying into solar panels, who are buying into wind power. They need software to be able to run that because wind and solar are not going to be 24/7 type of things. You have to have batteries to be able to store that power to use it at nighttime. And when that happens, well, guess what? You need software to be able to run that efficiently. And Tesla has that too. So you can see how this is not just a car company. They have some pretty good growth happening in the future, and that's why it trades at a 400 PE ratio or multiple, because it has potential growth, and they're so far lined up to be able to meet that growth. Now, what gets Tesla into a ton of trouble is Elon Musk and analysts who say, oh, Elon Musk, he promised this would happen by 2020 and it hasn't happened yet. Well, guess what? Things in technology, when you're looking down the road, especially when you're looking at somebody like an Elon Musk who will say that's going to happen 2 years from now, when in reality it actually happens 4 years from now. So keep that in mind when you're investing in these companies where Tesla's going to be shooting through the roof, and then they're going to say, well, nothing's happened yet. It's going to pull back down, and then when it finally does happen, whatever that goal or product or whatever it is happens, it's going to shoot back up again. And that's essentially how a growth stock that's safe in a way, is basically going to work. But you have to make sure that the company's making money. If they're not making money, then at that point you might as well go to the casino. So basically that's the difference between the two stocks. Myself, if you're a bit older, dividend stocks would be the way to go because you're going to be probably retiring soon. You don't want to have all of those up and downs happening with your money, and you want to have income coming in. Well, if you're younger, if you want to invest in dividend stocks like I do, that's fantastic. You can make a lot of money doing that, but you also want to have at least a small portion of safe growth companies. For example, Tesla's a safe growth company because they've got the growth, but they also have that product line coming down the road, and they have positive earnings. Another potential growth company going into the future that pays a dividend would be something like an Enbridge, because with Enbridge, they're moving away, they're not really necessarily moving away, but they still have their oil pipelines, but they're really going into electrical grids. They're getting into wind power and solar power and being able to distribute that. And because of that, they look, to me anyways, that there could be some growth there that not many people are really talking about. So keep in mind that when you're watching videos online, that everyone has their own opinion. Do your own research first. Hit that like button, subscribe. I hope that this video has helped you. If it has, I'll see you guys again next time.